And there's Pete. Perfect timing. Can you hear us, Pete?
I can.
Awesome. All right.
Should I switch off my background here?
I mean, you can represent, and I guess we're representing in a lot of areas. This is the most representation we'll have for our actual products in a presentation for a while, or some a while. But let's see if you can manage. Can you manage attendees and Q&A and everything, Pete?
Do you mean something besides Q&A?
Q&A and chat and just seeing.
Yeah, I can definitely manage Q&A and chat.
Cool. All right, we already got 45 people in here, and I'm sure more will roll in. But let's kick it off. Thank you, everybody, for showing up. I'm excited for this presentation. It has a really strong response, so it's great to speak with a larger section of our community than maybe all of our events. And we're going to dive into all the considerations around managing early equity in a high growth startup. When we say high growth startup, we mean a corporation, largely a Delaware C corporation, that is intending to raise funds from investors, give equity to their employees. You know, the eventual end goal is an M&A. So this doesn't apply to like local LLCs or proprietorships or anything like that. We're largely focused on C corps. And even if you're international, this should still apply because most entities have some semblance of equity and fractional ownership in a sort of a business unit that will be pretty specific on US entities. Before I jump into it, a quick introduction for myself, and then I'll pass it over to Pete. My name is Ryan Nash. I'm the CEO of Gust. Pete and I work day to day on a myriad of Gust's products, Gust Launch being kind of our flagship, which is something that helps a company run all of its back office stuff in equity management. And we have a ton of free additional tools that we work on to provide to the founder community and other people in the community. And we'll use some of those to demonstrate kind of the topic and the considerations of this talk. I'm an engineer by trade, moved into kind of management, executive, and growth stuff at Gust over the last couple of years. And now we're kind of a smaller unit focused mostly on Gust Launch and supporting the founder ecosystem. Pete, what about yourself?
Cool. Yeah, my name is Peter Swan. I'm currently the CEO at Gust. Ryan and I have been working on this stuff for quite a while, and we've learned quite a good deal. And it's exciting to do these presentations because we both have an individual contributor background. So we have come at this stuff having to learn it without the benefit of a legal or business background. So hopefully that gives us a little bit of an edge in terms of explaining it in terms that everybody can actually digest. And quick note before we get started, this will be recorded. We will send it out afterwards. If you have questions, please drop them in the chat or Q&A. I'll interject when they are topical and time sensitive. Otherwise, we'll capture them all and we'll get them answered at the end in Q&A.
Thank you so much for that, Pete. And yes, Pete and I, engineers background with an anathema to legal and business until we learned all about it while building products around it. And now we talk about it in depth all the time. But here we go. Be fair, protect your company, reward your teammates, and don't screw up your cap table. So before we even go into the nitty gritty of stocks and things like that, what is ownership in a company in general? So you'll hear a lot of things. People are familiar with public companies that have, publicly available stock in a marketplace where you can buy and trade. In the private universe, it's very similar in that the company is split up into fractions of ownership called stocks or shares. But there's a lot more stipulations and regulations around private companies, and you don't move things around. There's not an open market. What a company does is when they incorporate their company, they literally file a piece of paper with a state. Delaware is the most popular one for startups. That's what we serve. But that piece of paper literally says, I'm a company. I have this address. I'm going to do, legal business. I have some liability protection, and I have a certain amount of authorized stock. And that is a number, usually a very large number. The default is about 10 million. That just basically says I can issue up to 10 million shares of my company. That does not determine actually ownership of the company. That's just kind of like a high watermark on file in the state. It's after that, after you set up a company and get the thing back from the state, when you actually start issuing shares in that company, does ownership actually get established. So promising somebody equity, talking with a co-founder and saying we're going to be 50-50 owners of this company, that's not ownership. The ownership has to come with stock grant documentation signed by authorities of the company. Usually the board of directors approves it, and then countersigned by the person getting granted the stock. There's a bunch of other things out there that are paperwork signing that are not ownership or not ownership yet as well. So stock options you've probably heard of with like tech companies, those are the right to purchase ownership, but they don't give ownership. Convertible notes, promises, warrants, and things like that. A lot of these are securities, which is say you will get ownership in this company in the form of shares, probably in some point in the future based on either something happening or you requesting it. So a common question we get and a confusion with ownership is people think like, okay, I have 10 million shares registered in Delaware. So if I give myself 5 million shares, I'll own 50% of the company. That's not how it works. Ownership is only ever based on the shares that are issued and outstanding. So if you give yourself 1 share, you are 100% owner of the company. If a co-founder comes in and you give them 1 share, each of you now own 50% of the company, because each issuance changes the denominator, but the authorized shares is really just a thing that you filed. It doesn't actually determine overall ownership. So that's roughly how ownership works, is fractional shares of the company. As more and more people get involved in the company, you issue more and more shares. Ownership rebalances, people get diluted. And the reason why the overriding reason why we want to give this talk is these early decisions are very important, because most of the time as the founder of a company, you're only going to get more and more diluted as more and more ownership is given out in the company. And this is an example from one of our stock planning tools where you can see kind of like a later stage company split up into multiple kinds of ownership. So the common stock is often what founders get. We'll get into it in a little bit, but then you can see other people end up getting different ownership, and we'll get more details of this as we go along. Oh, and this is also the example of dilution. This company before pretended to raise a round, started out with very simple ownership, some common stockholders, a small equity incentive plan split between some issued and some not. And then we'll go into detail about what a round kind of looks like near the end, but they, create an option pool, they sign notes, they issue new shares, and you'll see there's much more players on the cap table, and the founders themselves have been diluted.
And it's a good reinforcement point here that dilution is normal.
Yes.
It happens when you sell equity for funding in your company. It happens to everybody who sells equity for funding in their company. The keys and why we were trying to educate with this presentation is you never want the amount of dilution that you undertake as a founder to come as a surprise. So keeping track of it and keeping track of it early and understanding how your early decisions impact it is super important. But dilution itself, par for the course.
Exactly. So let's first talk about the founding team. Usually the first people to get ownership and equity in a company. It's usually the most significant chunk. You see founding teams the size of a solo founder all the way up to 2 or 3 individuals, sometimes even more. But honestly, in most companies, it's not guaranteed. Every once in a while, a company comes along, 2 people, they have experience, they start a brand new company, they know exactly what they're doing, who's going to own what, who's going to do what. Most people's journeys are not that simple. It's somebody starting with an idea, they have a friend, they want to convince them to join them, but there's stipulations, things happen, and time is ever going into the future. So you want to plan for some flexibility based on where you're at now and where you think you could likely go. So often you don't want to just issue all the equity to yourself if you're a solo founder, nor do you just want to issue yourself 1 share, the example I was giving, because that has massive tax implications with the state. But you want to plan somewhere in the middle. So if you think of that 10 million as like, okay, over the first couple of years, I can issue up to 10 million shares. What is the ownership that makes sense now? And how much flexibility do I need to plan for? If you're a pretty well set team, 3 people, and you all kind of know roughly what you're going to own, maybe you issue, towards the higher end of 8 million of those shares to the founding team. Or if you're just a solo founder, you're looking for a technical co-founder, you need a third party to the team, maybe you go more towards 6 or even 5 million overall issued to the founders. So this is actually where we get to show off kind of a cool tool that we built. You can still see my screen, right? Is it full screen for everybody? So this is a stock planning tool. So this is in our product called Gus Launch, which actually sets up a company in Delaware, does all the registrations and filing, and helps you set up the board of directors and things like that. Once you get the directors and the officers set up with our kind of legal templates on automation, then you go on to planning the ownership. This isn't committing to it. Like I said, you have to sign documents to actually make it done, but this is to help visualize and conceptualize what a company's ownership is going to look like, or planning for the founding team. So like I said, even though we have 10 million authorized in the state, I can issue myself 1 share and I become 100% owner of the company. We can put a nice little warning here that you're going to get in trouble with taxes, so don't ever do that, but it helps illustrate that kind of thing. Say I have a co-founder name. There. Say I have a co-founder named Iris, and now we're actually talking about, proper share counts, something that would be on the founder level. Iris brings a lot more to the table than I do, because she's a cat. But here's, maybe a typical split allowing for some flexibility. We recommend definitely not touching about 2 million of those shares, not just for flexibility about what's going to be joining the team, but also to reserve for an option pool and maybe some other contributors that we'll get into in a bit. But you can see this split leaves a little extra room. Say I wanted to apply to an accelerator, or I really wanted this to be a 3-person team, but I know it's going to be a while before I find that third member. Say that's like a technical person. They're not a founding team member. Maybe they're not there from day one, but they are a significant contributor to the early days. This is kind of how dilution works. You can always say we're changing the denominator each time we issue new shares, and that dilutes anybody who was previously considered a shareholder.
And Ryan, we do have a pretty topical question here that may overlap with kind of the co-founder equity split tooling as well. Dan is asking how to define the founding team in the sense of what they do for the company, potentially versus what somebody like a tech lead might do.
Excellent. That's actually super topical and segues super well into the next slides. Those are just the same thing in case I lost internet or something like that. So let's talk about the difference between a founding team and early members. So this is one of the most important conversations to have amongst the founding team members and to get clarity, because unrolling this kind of stuff becomes very expensive, time consuming, and possibly even dramatic. It's very good to not just, stick with arbitrary numbers like 60-40 or 50-50, but to have the conversation more about what people are bringing to the table, how irreplaceable it is for the company, and how essential it is for company success. Not everybody might be coming from the same background or experience that realizes what goes into making a company successful, especially from the upfront and from the ground up. So a lot of times people, they have, illusions in their head, like, oh, Pete and I come from an engineering background. It is commonly thought like without engineers in software, nothing gets built. So we might overemphasize our essentialness of a skill set to a founding team. And we also say, hey, I could go make hundreds of thousands a year working at some big tech company. So like change my salary into ownership, I should be like 60% of the company. That's not actually how it works. One, engineering skill sets are kind of a commodity skill set. You can go buy it on the open market. Therefore, it's not super essential to the business. And also, if I'm not participating in fundraising, if I'm not essential to the domain experience that makes this, if I don't have an essential personal network to fundraising, or even just depth of exposure to potential partners and customers, like the company might not even exist without a member like that. Well, somebody who can develop a web app, you could go find somebody who could contract it and not. So it's important to think about those things, have those open conversations, realize it might be learning for everybody. There's a thing out there called the Founders Accord, which is like a pre-incorporation document that helps founding teams sort of kind of loosely cement, not super legally binding, but at least being a bit more serious about the conversation and getting one signed. And there's also some really great tools out there to help with the conversation. We have actually built one ourselves. It's called Co-Founder Equity Split. It's actually a very in-depth tool that takes some time to go through, maybe 10-15 minutes per co-founder. So I'm just going to put some screenshots up here, but it asks a lot of relatively weighted questions about what people are bringing to the table. So you can see even these are some examples, like who builds the product, and who understands your customer problem thoroughly, is the expert on it, who's taking a salary. These are differentiators a lot of people don't bring into the conversation, or who's even putting in their own money. So this allows you to take your co-founding team, whether they're all founders up front, or maybe like a group of individuals deciding who's a founder, who's more of an early contributor, and walk through some nice Q&A. And it's relative weighting, so it's not like you need to be specific to like has a PhD or has made this much money. It's much more of like the relativity between the contributors. And eventually something like this is going to pop out. Now, I will not say you immediately take these numbers and grant shares to all these people because, hey, the tool told me this. But what the tool does do is it exposes all the dimensions of like value creation that go into a business and weights them against each other. We build this based on industry statistics, companies we work with for decades, valuation reports, all sorts of good stuff. It gives you a little bit of feedback, but this is great because you can share this to somebody else and they can go and fill it out and they'll get their own split based on their perspective and share it to a third one. And then eventually it amalgamates it all and you get kind of the blended thing, and the conversations in and around it are very helpful for a team to have. Did that cover the question, Pete?
Yeah, Dan followed up a little bit in terms of somebody that has a part in the initial idea, but did not participate in the active work. I think that's generally a trickier question, but at a very high level, we would consider that somebody who is not putting in as much work or as much value in terms of time, effort, and money would not be considered a co-founder. Your co-founders are the people who are living and breathing this thing. In situations like that, you may be able to find a smaller percentage of equity or even another type of value transfer that would have that person be comfortable signing over the intellectual property to the company so that it can continue.
Yeah, definitely. It's very much something you might hear in this space a lot is like ideas are worthless. They're not exactly worthless, but even the best idea in the world without a lot of execution isn't worth very much. The same idea, the same business, like how many Instagrams existed, at the same time in the App Store to just share pictures, like probably thousands. But it's really all about the long term. You're talking year over year execution. So anybody that was around just like incubating an idea together, a lot of times people very much weight that as like, oh, that was the point of brilliance. But it's like, actually the point of brilliance was every single day over the next 48 months when people worked and learned and pivoted and did research and changed their minds and raised funds and things like that. And this is also, I'm going to say this for a little bit because we're going to get into it. This is why vesting is incredibly important, because people can be involved early and upfront at the idea stage, even at the kickoff stage, and they're working and something can happen, but you want to protect that. If day one you decide that Otto is going to own 30% of your company and day 20 Otto has to just leave, you want to be sure you're protected, and we'll get into that in detail in just a bit. Actually faster than I anticipated. Here we go.
And one more quick question before we move on. Jenny's asking about a normal or standard amount of equity when you're giving it to early team members who aren't founders, but who have been with the company kind of since the beginning.
Okay. So yeah, standard, if we go back to kind of what we were looking at here, I sort of hinted at that. A single percentage of a company in the early days, I think this is maybe a good heuristic, is pretty substantial. Like 1% of a company, when that company goes on and is successful in the order of high growth startups are, it's still going to be a pretty generous amount. So really early team members, you're probably thinking in low single digits, possibly even fractions of digits, depending on what they're bringing in. Like if you started a company, you got some work from like a lot of brand new college grads, but it wasn't like they were a founding team member. They weren't working 60 hours a week on this venture. They were just kind of helping out because they liked you. You could think of small fractional percentage or single digit percent. You can see here like 500,000 shares is 7% at the beginning. Sometimes if you go to like, you'll even see this with consultants and contractors, they will often give you below market rate in exchange for a little bit of equity as well as the payment. And you're looking at low hundreds of thousands, maybe tens of thousands in those kind of grants. If you're a 10 million shares company and you're giving yourself 6 to 8 million, or you're giving the real founding team 6 to 8 million. And I do see a question about advisors.
Let's go ahead and round it out.
We'll get into detail about advisors in a bit and what makes advisors advisors, but fractions of a percent, a tenth of a percent, a quarter of a percent. That's kind of the level of early equity grants for advisors. All right, and can we jump into vesting, and then we'll circle back on contractors, advisors in depth a little later in the presentation. Cool. So what is common stock vesting? You should have common stock vesting on every common stock grant you do. Technically, this is what's called reverse vesting. A lot of people are familiar with stock option vesting. If you go and work in a tech company, they might grant you, 10,000 shares of options. And what that is the right, but not the obligation to purchase shares at the price that's on the share, called the strike price at the moment. Very, very common for tech employees to get these. And what happens with those options is almost every company vests them over time, usually 4 years or so. And what that means is every month after usually a cliff, you get the right to purchase more of your overall grant. So if somebody granted you 10,000 with vesting, as you kind of earn those rights, you can exercise more and more of those options. Common stock is different. When you grant common stock to somebody, they immediately own it in terms of the governance perspective of the company. So they can vote with that. They are now a shareholder. As long as they are with the company and still, serving the purpose of the company, what we call a service provider. The IRS considers this ownership too, but the company can take that ownership away if you tend to leave the company or you're terminated for whatever reason, amiable or not. So this is a huge protection. And what they call repurchase is actually repurchase at the same price that it was granted. So when you start out, I mentioned you have 10 million shares authorized in Delaware. You have to give those what's called a par value, or the lowest price they can be sold at. When a company's brand new, it's basically worthless. All of our companies start with a par value of 0.00001, so 4 zeros and a 1. That's good because that means the founding team can purchase those super cheap. 5 million shares is $50, nice and easy. The transaction's really clean. You bought your ownership for a very cheap amount of time, and other founding teams as well. However, if a founder leaves or a co-founder leaves later on, even if for good reason, right, they have a family issue, they can't devote the time to it anymore, they shouldn't be able to walk away with 30% of their company just because they were there for a couple of weeks. So this vesting allows the company to repurchase it for the same amount. So if you had somebody who had, 30% or 3 million shares, you could be like, oh, I'm sorry, it didn't work out. Here's $30, I get all my ownership back as long as nothing had vested yet. So we can actually get into what those vesting schedules actually look like. So the most common one you'll hear is 4 years with a 1-year cliff. This is generally considered for the founding team, often for early team members, anybody who's going to be kind of here for the long haul. How that cliff works in detail is, can you see my screen, Pete? I just got a weird notice. Cool. How that works in detail is the cliff is kind of a settling period. So you grant somebody a 4-year vesting schedule for however many shares, but you give yourself a 1-year cliff, meaning that nothing vests until that person has been there for a year. That's important because it takes a while to figure out, if you've worked in a company, like if it's a good fit, if it's going to work, and you don't want to spend a lot of time, trying to get something to work with somebody and then, constantly lose ownership of the company in the process. So a 1-year cliff is very common. As you approach that cliff, you can really decide, was this worth it? Are we working well together, or should we part ways? And then once that cliff happens, every month, on average, you can make milestone-based vesting schedules. You could do quarterly if you want to, but it's very common in the industry to just vest more every month. And so if you're outside of the founding team and you want a more custom vesting schedule, we advise to line them up with what makes sense to recognize the value of the relationship. So if you're a bunch of co-founders and you're coming together and you're kicking a thing off day one and not a lot has been done, pretty standard for everybody to have 4-year, 1-year cliff, and let's go and let's see if we can make this work. However, if you have somebody that you're contracting with or you're working part-time with and you want to give them a little bit of equity, but it's task-based or something like that, you want a deliverable by a certain time, you can set up the vesting schedule to reflect, one, giving yourself enough time or your company enough time to realize the value in the relationship as a cliff, and then the full-on duration to extend to the length of the relationship. So say you're going to work with a consultant for a year, you're going to do some tech work and dev and whatnot, and you hope to get an app out in 6 months, maybe make it a year vesting schedule with a 6-month cliff so that, the company is never in danger of just having a chunk of its cap table given away without anybody who's creating value for it. It's also important, we get this question all the time, is like, well, I'm the founder, it's my idea, the company doesn't exist without me, so I don't need vesting. Until you meet anybody else, like an investor who wants to invest in you, even though it might be the only one, even if you're a one man, one woman show, it really demonstrates that you are in it to anybody else that you're trying to convince to come work with you. If you're earning your right as well, it's largely expected, and if you don't do it, they'll probably force you to do it anyway. And if you haven't done it, that means legal work, cleanup, drafting up things, fixing up history. It gets expensive for something that's really easy to do up front. And there's a little bit of conversation in this space. I think the 4-year, 1-year cliff, Pete and I have been in this a decade and it hasn't budged up until recently. People have been talking about slightly longer vesting schedules, knowing that it takes longer to go public. Companies are staying private longer. The most important thing with the vesting schedule is to match it to the narrative of your company, the person's role in the company, and what success really looks like, and fit it as well as you can.
Yeah, and I think specifically fitting it to the amount of time you expect that person to devote to the company.
Yeah. And you don't have to predict the future entirely. You can always grant more stock or you can grant more options. So a lot of times you see these things come in like recommitments, right? If you have an early contributor, you do a whatever vesting schedule, and as it's coming up, you're like, hey, we're still in this, we still want to make this work. Another stock grant would make a ton of sense in that case, and that would also have vesting to cover the continuation of the relationship. I think we got everything that's there. Yeah, this is a Gust Equity Management. This is a dashboard for an individual shareholder. You can see that stair step thing is sort of how to think about vesting after you hit your cliff. You can see this person hit a cliff some time ago. But each month, it looks like in the middle of the month, they vest an extra amount of shares. This is a founder level, solo founder level grant, which is why it's so much. But on and into the future.
Nash, can you quickly recover what a cliff actually is?
Okay, a cliff is either a date or a passage of time that you put into the stock grant that says, all right, this is going to vest over 4 years and nothing vests for the first 12 months. However, at that 12 months, the full year of vesting happens. So for example, if you were granted, let's do something that makes the math easy, 24,000 shares in a company with a 2-year vesting schedule with a 1-year cliff. From day 0 to day 364, you would have no vested common stock in the company. As soon as day 365 hits, you would vest 12,000 shares, half of the grant that you were given, because 12 months has gone by. And it was kind of like reserving that, being like, hey, we're figuring this out. But as soon as, like, if you've been here for a year, ka-chunk, you get your whole year. After that, every single month, another 1,000 shares would vest until you vested all the way up to the 24,000 shares. Sorry, I forgot to mention the cliff all came at once. Is that good? I don't know if I'm asking Pete or, all right, cool.
Yes, you're good.
So vesting comes with a wrinkle. There's a lovely word, irrevocable, that I can never say correctly on the first try. Maybe that was it. But shares are often considered income. If anybody's played with stocks, you buy them and sell them, you make money, capital gains, sell them earlier, it counts as income tax. The IRS very much cares about people moving shares around. So this is, level set, this is an individual concern. So this is somebody who is a grantee and receiving shares in a company. This is for their personal taxes, not the company's taxes. So as you receive ownership in a company, the IRS considers it an income event as long as that stock is irrevocable, meaning it can't be pulled back in any meaningful way. Vesting is can pull it back in a meaningful way kind of thing. If you leave the company can pull it back. So what the IRS by default considers a grant with vesting as to be an income event at every vesting milestone. So if we use that the example with the 24,000 shares and the 1-year cliff, in the IRS's mind, that individual got granted that amount of stuff, but they can't get pulled back until the first year and then every month after that. So for each month in the second year, the IRS would consider those 1,000 shares an income event, which you would have to add to your income event based on how much the company was worth at that time. For a startup founder, for an early team member, nobody wants that. The whole purpose of starting a company from scratch is that it's going to appreciate in value. And hopefully by year 2, year 3, year 4, we're not talking about a $10, $50 company, we're talking about a $10 million company. And if you're vesting a couple 100,000 shares every single month in a company that has raised funds and has a price of $10 million, you don't want to recognize that income. Your whole point of those things is you're going to sell those shares eventually in an IPO or an acquisition. So the IRS makes an affordance for this not to get around this, but to treat the stock grant differently. And that's what's called an 83B election. And this is very important because there's a deadline on it, which is 30 days after the grant date. What an 83B election is you're telling the IRS that, hey, I don't want to for tax treatment, I don't want to think of this as income events for the next 4 years. I want to take the income hit all up front. I'm going to waive my right to claim a loss on this, but I'm going to do it all in this year. And what that means is basically you've got granted these shares. You said, hey, I'll take the income event up front. It's $50 and I paid for it in cash. So it's not an income event. I didn't just get free ownership in a company that was actually valued at something. And we're good. The IRS will no longer bother you or think that you're having income events when you're filing your taxes 3-4 years later in the future. The most important thing is in order to tell the IRS this, you have to literally wet sign a document and send it to them and say, I am making this election now within 30 days of the grant date. And the IRS is really stingy about people who miss this window. So this is actually an example from our platform, the one that does the company back office. Because it's still a wet signature, we don't have a digital solution for it, but it is something we beat people over the head with. We send them alerts at 2 weeks, hey, really file this, you're running out of time. We say we actually advise to send 3 copies of it. The wet signature one for the IRS, a copy you want sent back to you through certified mail with a self-addressed stamp envelope. I haven't heard that since cereal commercials as a kid, but it is still the way it is. The IRS has said they're going to modernize this at some point, but they have yet to yet. So platforms like ours remind people as well as pre-fill this stuff, but it's very important, and it's very important to communicate this to everybody on your team and team contributors and things like that. As the founder, you want to be sure that they file their 83B elections for their own sake, because you're probably going to be aware of this more than they will, especially if they haven't worked in startups before.
And that is why it's helpful to use a platform We do have one other really relevant question, and it's an interesting one, and I can't type an answer, so I'm just going to interject and answer it.
Yeah, great.
Anonymous attendee is asking, is it right that you take an 83B election if you were long on the company and really believed on it exiting at a higher valuation at some point? This is kind of an interesting question because the answer differs depending on the stage of the company. If we focus like where the presentation is focused today and focus on early equity, then typically the grant you're receiving is going to be at par value or close to par value, which means the value of the shares that you are issued at that time is very, very, very low. So when that is the case, there isn't really much downside to taking the 83B election, whether or not you believe in the company. Although if you're joining a company at this stage, I would hope that you believe it because you're probably not getting a market salary either. So consider it carefully. Now, typically later in the company's life, you aren't getting a vesting common stock grant. Typically, the reason you're not getting a vesting common stock grant is because as the company builds value, the common stock share price goes up. And once it goes up to a certain amount, any substantial grant is going to be cost prohibitive to buy in. Or if you receive it without a cash payment, you're immediately going to have to pay income tax on something that isn't liquid. However, if you do find yourself in a position where you are getting a common stock grant for some reason in a company with a share price that is significantly higher than par value, that is when you have to do the calculation. Because if you get a vesting stock grant at that point and the company's share price goes down, then it would not be financially advantageous necessarily to take the 83B election and pay all of your income tax up front.
Yeah, Logan asked in the chat, and you had it in there, but I'll restate it. Stock option grants do not require 83B elections because they're not ownership yet until you exercise them. So
yeah, there may be cases with early exercise and stock option grants where it might apply, but an 83B applies to a common stock grant that has vesting attached to it.
Yeah, and I'm sure this question will come up if I haven't been able to scroll, but what happens if you're not a US taxpayer, you're a foreign person? So anybody can start a Delaware C Corp and be a member of a Delaware C Corp. Delaware doesn't care. They will allow you, they will be happy to take your franchise tax payments. However, the guidance we apply is if you're not yet a US taxpayer, so you don't have a tax ID, an SSN, or an ITIN, but during the vesting schedule of the grant you're receiving, there is a chance that you might end up being a US taxpayer, whether you immigrate to the United States or some other series of business or whatnot that you might end up there. We still advise to do that. So you can just put foreign. You can see on this field, the second field on this form, the tax ID SSN. If you just write foreign into there when you file your 83B election, and you get all the copies, you're protected. So if you ever do move to the United States, even unexpectedly, and the IRS is like, haha, you could be like, no, I filed this appropriately. Are we good to move on, Pete? I know I see a lot of chatter. I can't screen it.
Yeah, it's good. I'll continue to screen.
Awesome. All right, so let's go into, we've kind of taken pot shots of this from the side, but who else gets common stock outside of the founders? So those common entities are advisors, contractors, accelerators, incubators, and early contributors. Usually all of these are much smaller grants. You're not talking about millions of shares. Like I said, tens of thousands, maybe low hundreds of thousands. And they still, if it's early days, like Pete said, and the value of the company is still small, they would still have vesting schedules associated with them, but they might mirror the terms of the relationship more than your standard, like you're in this for the long haul. Each one has a bit of a consideration. So first we'll jump into advisors. So advisors for a company, you can talk to a lot of people at a company and people will give you advice. But a formal advisor relationship is something that you actually want paper. There's a lightweight document, it's kind of like a lightweight contractor agreement that basically sets up the terms as well as protects the company in terms of sharing secrets, noticing of advising for competitors or working for competitors or things like that. Be sure you get the document signed. And if it comes with an equity grant, which it usually does, you will want appropriate vesting and the appropriate ownership percentages on that. So before we get into what's appropriate, what is an advisor? Usually it's somebody that has 2 to 3 times the experience of the founding team, somebody who is probably later in their career or has made substantial progress into it. They often help the company kind of level up, whether that's raising a new funding round, entering a different market, landing a major deal in something like an enterprise company. They have the network, the experience, enough that just talking to these individuals can usually move the company forward and open up doors. Even though they're, legacy people, they don't get paid. and the grants are usually a fraction of a percent. They're not going to work full time in the company. They're not going to be rolling up their elbows. They're generally not, individual contributors. Usually the outcome is not going to be like, oh, they wrote software, they drafted up a legal document. It's going to be much more in terms of advice, connections, and perspective. There's a great way to actually get hard numbers on an advisor relationship. One of our friends in the space called the Founder Institute publishes something called the FAST agreement. The FAST agreement is that aforementioned advisor agreement that just sets up the terms and protects the company, or sets up the relationship and protects the company. And it also comes with a worksheet to figure out what fraction of a percent is fair. And it takes a look at the company stage as well as the level of the experience of the advisor. And that goes anywhere from 1/10% to maybe 0.5%. You could see possible single-digit percent advisors if they're extreme heavy hitters in an industry. If you got like a household CEO, dead in your industry on there, maybe. But often they're pretty small. The common vesting schedules for advisors too are a lot shorter. One, because these people are bringing a lot of firepower to the company, and it should be relatively easy to experience it. A connection, an investor conversation, things like that do not take 10 months to do. So the most common advisor vesting schedule is 24 months total with a 3-month cliff. One, you should realize that value really quickly, and often the advisor's specialty is going to be a phase in the company that is moving from one to another. So it's usually about 2 years. If you're raising a funding round and it takes you 4 years, chances are that round never got raised. So advisors are really kind of stage appropriate. So they have shorter vesting schedules. And the number one thing here, the red flag at the bottom, is if you have an advisor asking for both equity and cash, that is usually a red flag. One, that they're either just inexperienced advising startups, in which they might still have really good advice, but you could send them to us or one of these events or something like that, or they might be running something. If somebody is asking for cash compensation in exchange for helping your company out, that sounds a lot more like a contractor, somebody who's actually doing work for the company. Any questions on advisors before I move on? Oh, you can find the FAST worksheet at, I think it's just Founder Institute. So it's fi.com/fast, I believe, or maybe fast-agreement, but Pete might be able to drop that into the chat.
Yep, I'll drop it and include it in the follow-up.
I will say, if you are a Gus Launch customer or will be a Gus Launch customer, like I said, the FAST agreement is the advisor agreement plus a worksheet. It does not dictate the actual stock grant. It just helps you figure out what the value would be. You still need to go and do the stock grant, the appropriate stock grant documentation. So if you're a launch customer, you end up as one, don't use the FAST agreement to set up the relationship. Use the Gus Launch advisor agreement to set up that relationship, and then use the FAST worksheet to figure out a fair percentage, and then use the stock grant on the launch platform to actually do the grant. And don't think that just because you signed the FAST agreement, if you're already incorporated and off and running, that's not the ownership. You still need to go and get the appropriate board approvals and stock grant documentation done before they're actually an advisor. On last note, until you have those agreements signed, do not put advisors in your pitch deck. If you're talking to somebody who is just like, oh yeah, like an expert in the field, and I shared my idea and he really seemed to like me, don't be like, well, now he's an advisor. It's a small world out there. Things get around. People ask. Easiest way to do diligence is just to ask the people that said that they like this company. If they do, that's a single email, and that could nuke an entire deal. Contractors. I've hinted at this anyway, not exactly, like a bit more detailed. They're going to do work for you. Sometimes they'll get paid in equity and cash, sometimes in both. And often you can get discounts on market rate by granting equity, as well as paying under market. We even have a good friend of ours, both Pete and I used to work at Gus. His name is Mike Frederick. He has almost formalized a developer work for equity in the form of safes. That's Flatiron's development, I believe. And there's more and more of that happening. So again, usually fractions of a percent or low single-digit equity grants, depending on the scope of work. And the vesting term should match the length of the engagement. And I'd give yourself some room and flexibility. Having hired enough contractors in our time and agencies and whatnot, the ambitious plans of like, oh yeah, we'll do this in 3 months. And then you really like the contractors, but you realize the scope is very different, or you've pivoted, or the company's changed. So, if you're hiring a contractor and saying, build me an app in 3 months, and put the entire vesting schedule at 3 months, like I'd probably give yourself just a little bit of wiggle room on that. And just like the advisor agreements, be sure that there is a contractor agreement in place. It's a little bit more heavyweight. It has general terms because money's changing hands. They're going to have to file this as 1099. You do not want to, pay benefits and take them on as a W-2 employee. That just sets clarity in the relationship. And it also gives you an agreement to terminate. Same with the advisor agreement, should the company feel like they're not getting value and they want to repurchase the shares based on the vesting schedule. Third one we talked about, accelerators. Also accelerators and incubators. Incubators, the terms are getting thrown around. Accelerators seems like the general fit term. Accelerators have been around for maybe like 15 years or 20 years or so. YC is the most prominent one. You've also heard of ones like Techstars and Mass Challenge. These are organizations aimed at like accelerating startups, moving them to the next level, whether through connections, network, education, access to resources. It's a really cool ecosystem now where we're seeing like an explosion of accelerator models. It used to be very kind of straightforward, like a business boot camp where they take a small percentage of your company, they'd run you through like a crash course 3-month program of a lot of the concepts that we're talking about today, like why Delaware, 83B elections, product market fit, yada yada. And notably, like YC takes 7% of the company and invests 125,000. But now we're seeing tons and tons of things. We're seeing pay for accelerators that don't take any equity at all. They just run you through a program. We're seeing mixtures of accelerators, and we're seeing them take their ownership or their upside protection in anywhere from common stock grants, warrants, safes, which are convertible instruments we'll talk about later, or some weird thing. I'm sure somebody's inventing some bizarre accelerator model right now. One thing to look out for is a lot of times we've seen accelerator instruments or equity claims that have like overly defensive dilution protection in them. It's not necessarily a bad faith thing on the accelerator. It's just because the company has so much power early on with a small board of directors and a small amount of shareholders. Accelerator doesn't want to give a lot of value, and then the founders just turn around and be like, boom, we just issued ourselves a ton more shares, so now you're barely an owner of the company. But just be wary of it. Make sure you read the documentation, make sure you understand it, exactly how much your company are giving away to participate in something. If in startup space, if everything works well, everybody's usually pleased, right? If an accelerator helps you land that check, helps you build your product, helps you get to revenue, you'd be happy to pass on some of that value in kind. But just being clear about how much they're asking for and what sort of stipulations come with it. All right, so now we've covered most of the people who get common stock: founding team, early contributors, contractors, advisors, and accelerators. So we've hinted at this as well. It's like, well, what happens after that? Eventually, you kind of run out of granting common stock because your company has appreciated in value to the point where if you hire a new employee and you say, hey, here's 10,000 shares, by the way, give me $10,000 for them, the new employee will probably be like, I've never paid to work at a company before. It's like, all right. So instead, we move to stock options. And I've said it a couple of times before, it's the right, but not the obligation to purchase ownership of the company in some future. If you're not forced to adopt an option plan in a funding round, you might want to do it earlier because of either the company's too expensive to grant stock or just the hassle of having so many shareholders, holding common stock at a company. But the more common the more common time to adopt an equity incentive plan is when you're doing a funding round. Investors understand that stock option incentivization is very good for companies. It helps them attract talent. It helps them hire motivated individuals in the space. And almost all fundraising is done to expand the people working on your company. So investors will often kind of, in the terms of the negotiation of the funding round, they will want to see an option pool of a certain percent. Not only are options free to grant, and they're a little bit more flexible in general, because option holders don't have voting rights. The company itself, the CEO generally is called the administrator of the stock option plan. It's a little easier to kind of move these around and terminate them and void them than it is with common stock. But the reason why you wouldn't just start out with stock options from day one is because they do have a bit more upfront compliance obligations. So one, to adopt the option plan, you have to have a shareholder vote, even the whole shareholder base of the company, and you have to put a price on them. And the price is generally not the same price on the common stock if you're at the time of adopting a stock option plan. It's actually something called, before I jump into this, anytime you grant a stock option, it needs to have a strike price, and that is the price the employee is going to pay to exercise the option, or the grantee. Doesn't have to be an employee. Like we said, your company usually starts with a super low price, 0.00001. But later on, when you grant a stock option plan, it's quite likely that your company is increased in value. It still might be low, it might be a cent or something like that, but you need to determine what it is. And in the early days, most companies have no idea how much their company's worth, not even the investors who invest in them. You're putting a lot of faith into the founding team, into the market, and it's a high risk field in general. So to say a company is worth $5 million or $15 million or $7 million is very difficult. But thanks to Enron, actually, the IRS and is the IRS or the SEC? I think it's the IRS. They've created a regulation that when you grant stock options, the logic that you put into setting the price of those options needs to pass a certain level of muster or an eventual audit. So the company itself can price the options. They could like literally be like, all right, these are worth 20 cents now, and here's our option plan. You probably don't want to do that because the grounds of how you determine that valuation needs to be backed up by an auditable method to saying like, oh, we looked at public markets in the space that had previously been private and then went public and what they were worth at the time. We've looked at competitors. We've looked at the Black-Scholes formula. We've done spreadsheets. We've done all these things. Most companies don't want to do that, shouldn't do that. So almost everybody gets the 4NNA valuation or the valuation to determine the strike price from an independent third party that has a record of doing these valuations and standing up to audit. The reason we thank Enron for this is because they were doing funny stuff with strike prices and stock buybacks and all sorts of things, which inflated the value of the company and caused this regulation to come into effect. So it's generally a good thing to protect against fraud, but it's a bit of a pain in the butt for companies to do it early on. So what they do is you basically send over all your company's history and information, projections and revenue so far, and they run a bunch of these formulas and they do a bunch of analysis and they come back and they say, your share prices are worth this much. Now you can go grant stock options. It can be expensive if your books aren't in order and things aren't cleaned up well. The back and forth with the 4NNA provider, could add to the bill of the whole thing, and especially if the company's complex or it's not well tracked. So keep your books in order. Use cap table software rather than spreadsheets. Services like ours really help companies stay on the straight and narrow so that these things can be done a lot more cheaply. The biggest value proposition of our highest tier of our Gus launch product is because we can get 4NNA valuation super cheap because we do almost everything for our companies when it comes to equity filings, vesting schedules and things like that. So we can send all that data over to a 4NNA provider and it's a super quick valuation. This is some examples of some of our tools in our software where it just makes it easier to see, when the valuations occurred. This would be a far along company over here on the right. And it also allows you, as you price and keep track of these things, eventually your company becomes very complex and the visibility of like, well, what if we sold? Like who would get what? This is what's called waterfall modeling over on the left. There's a lot of tools out there to help so that you can really plan for this sort of stuff and simulate. The last consideration on option pools is they're a little bit different than all the other common stock grants because you reserve a chunk of your company during the negotiations, usually with investors. So when you adopt the equity incentive plan, if you look back on this screen, it's down on the right that says, oh, this is the date that we adopted it. The shares allocated to the plan are 1 million. That whatever that percentage of your company is largely going to be kind of, don't think of it as immediate dilution on the founding shares, but it will be constantly negotiated at each new funding round, which means it will eventually dilute you as the founding team. So Jose Anser, one of the lawyers in our legal network we really like, has a great blog post called It's Option Pools, Not Oceans. Don't arbitrarily pick the percentage of your pool based on what the investors say, what you read on the blog. It's like, oh, 15%, oh, 20%. It's like match the pool at each round of funding to mirror the hiring plan you have for the use of those funds. So if you look at, you do a seed round and you want to hire a staff of 15 to hit these goals and you figure it out, the kinds of things like, oh, we need 15 people, these kind of grants, that's like an 8% option pool. Like go for an 8% option pool. Don't arbitrarily pick 15% just because it was in a slide deck somewhere or some investor said it. You want to be sure you're intentionally carving out the pool at each step to not overly dilute your follow-on funding rounds. Any questions on that before we jump into convertible times?
No, I think we can grab everything at Q&A, but try to get through these next couple because we are running short on time.
Yep. So the last early equity holder. So technically not equity holders, but we went over a lot of common stock considerations, stock option considerations. Let's talk about investors. So there's hours of other conversations, and keep an eye out for a future event program we do around fundraising. But early on, like I said before, nobody knows what your company's worth, not including you, not including people who give you early money. So spending time trying to peg the actual value of the company is usually not fruitful. So most early money comes into companies these days in what's called convertible instruments. The most common ones you've heard of are SAFE's, Simple Agreement for Future Equity. It's a fun acronym. or convertible notes, which have been used more for the last couple decades and are still popular, although safes are definitely gaining popularity because they're a little bit shorter. So they're not immediate equity. They don't come with voting rights. They don't come with 83B elections or anything like that. What they are is, as kind of the name of safe, it's an agreement for future equity. And so it's a setting of terms and some investor protections that say, hey, I'm going to give you $50,000 now, and we'll figure out what your company's worth in your next funding round. And once we figure that out, I'll get a discount on the money that I gave because I gave the money up front and it was riskier when I gave it to you. Most semi-professional and professional investors will insist on what's called a valuation cap and possibly a discount. They're both kinds of discounting, and it's basically giving the money today more buying power at that future round. So a discount rate is the most common one. It's usually 20%, which is saying, hey, I'm going to give you $100,000 today. Later on, when we figure out what your company's worth, I get to buy with $100,000 with a 20% discount. So if later on we figure out, hey, your company's worth, $9 million and you have so many shares, so it's $1 a share, I can buy those shares for 80 cents each. So my buying power increases at that funding round. The other thing is a valuation cap. That is an investor protection. That is, if your company has a massive success to the point where 20% isn't going to be that much of an incentive, those investors convert as if your next funding round was at a smaller value. So say you take $100,000, there's a valuation cap of like $6 million on the convertible instrument. And then the next time you raise funds, your valuation is like $30 million. Even though that investor gave you $100,000, 18 months ago, $100,000 does not buy a lot of a company that's worth $30 million. It buys very little. So they took a lot of risk and they didn't actually get the reward for it. They're just a tiny, tiny shareholder now in the company that they, were probably existential and, started. So instead, they would convert, if they had a convertible instrument with a valuation cap of 6 million, they would convert as if the company first raised at 6 million, because $100,000 can buy a lot more of a $6 million company than a $30 million company. Therefore, they'd be a larger shareholder in the $30 million company to give them credit for that early capital in. That is for a whole other conversation. We have a whole presentation that digs deep on how to think about convertible instruments. The simple thing to do when thinking of early equity is the amount of money that investors coming in divided by the valuation cap is the rough percentage of ownership you're giving away in the very early proto company. The common, principle is you want to sell off between 10 and 20% of your company in each funding round. So if you're doing a pre-seed funding round, not a seed price round or anything like that, think of the safes and the convertible notes that you're signing as if that is the kind of case. So don't, sign off 10 safes just to roll in more and more money at the same valuation caps, only to find out you've sold off 25% of your company before you even brought a priced round into it. And this is an example. This is from Gust Equity Management. I think I actually have a tab on this where I can share it a little nicer. If we take a look at this company here, we can see this company has common stock, as we talked in depth about, as well as an option plan of about 900,000, and they've signed two kinds of convertible instruments. So when we think of that company going and raising a preferred round, this is why cap table tools are great, because you can actually do the modeling. The math is hard. It gets very cyclical. Spreadsheets sometimes break and tell you mean things. Let's not do an option pool expansion. But you can see here, the company starts out pretty straightforward. You have the common stockholders. That's probably just the founders. And they've adopted an equity incentive plan to incentivize their employees. They own the lion's share of the company, and there's roughly 13%, reserved for the employees. If they were just to raise a preferred round of investors, this here we have them at raising 1 million at a 9 million pre-money valuation. They get diluted by a little bit. They lose roughly 10% of their company. That's kind of fair. The company's worth 10 million, et cetera. But if we convert these convertible notes here, there's an intermediary step where this all kind of happens at once, but the intermediary step figures out how much those notes can convert to. And you can see for around 800,000 that these pre-seed investors gave, I just know that from setting this up, they already own, more than 10% of the company when they're done. So the new series of investors have 10%, the old investors have a little more than 10%. And that's maybe not a bad thing for the history of this company, but you want it to be a strategic thing that you're aware of up front when you're signing these agreements, rather than a surprise when you're actually getting preferred interest and you go and start clicking through these or looking at the pro forma cap tables and being like, oh, whoops. Right, and I think think that does it. Yeah. So we do, like I've finally mentioned throughout this presentation, rather than just using silly pictures of my cats and little animations, we have software that makes all of this a lot more manageable. It's a lot. We spend all of our days like learning about keeping up to date on this, but Gust Launch, Gust Equity Management, the co-founder equity split tool, we have free and premium tools that make this a lot easier, and not just make this a lot easier so that you have to understand everything I said, but rather kind of hold your hand a bit and put the guardrails in place so that when you're setting up your company, when you're running it, when you're making grants, we pop little windows up to being like, hey, this is super non-standard, or like you saw earlier with the cap table planning, like, oh, you're giving yourself one share. Well, you're going to get a really big franchise tax bill because it's some esoteric, Delaware filing law. So we really handle all this stuff. And plus you get to talk to Pete and I and a bunch of our teammates. We do events like this, we do office hours, and we even have a whole network of lawyers we can introduce you to when things get, lawyer time. We should be able to automate and educate 80 to 90% of it, but you really do need to talk to bookkeepers, lawyers, and accountants at the right time. But how about you talk to them about important stuff for your company, not the rote standard boilerplate stuff that we deal with every day.
Yep, and we can help you figure out when that right time is and make sure you go there with actual questions instead of an educational agenda.
Exactly.
Brian, I'm sorry that I made you add that last slide because it definitely took 5 more minutes. I will give you a speaking break and run through just some of the questions really quickly. And then folks, if you have more questions, please put them in the Q&A. We'll try to get through as many as we can. I think we can both stay about 10 minutes over.
Yep, perfect.
So first, we had a question about somebody who is contracting with somebody. They're approaching a 1-year cliff. They don't feel as though the relationship is working out and are wondering, does it make sense to end the relationship earlier rather than later? I guess at a very high level, as long as you're within the cliff, you should be in good shape. But especially if you're not using a platform to manage this stuff, make sure that you tag in counsel and get opinions, because anytime you end a relationship and repurchase equity, there is the potential that somebody is not going to be happy about that. And even if you believe that you did not violate the spirit of your agreement, they may believe otherwise. And in the U.S. system, that means that they can bring suit against you. So that's a good time to tag in counsel. We had a few questions about 83Bs and non-U.S. companies. 83Bs only apply to U.S. taxpayers who are getting stock in U.S. companies, or people who may become U.S. taxpayers throughout the vesting cycle of a common stock grant in a U.S. company. And we had a quick question about milestone vesting. You can write in milestones to your common stock agreements. However, just be very careful because milestones often change frequently in early stage startups. Our purview is that time-based vesting gives you a pretty broad brush, and typically all employment in an early stage startup is at will. So if the relationship isn't working, you can just end the relationship rather than trying to rewrite milestones and undertake additional legal work to update those stock grants. Okay. Into the Q&A. We had a good question about the relationship between common stock value and company valuation. And Ryan talked about this throughout the presentation, but typically at the very early stages, the value of your common stock is par value, which is very, very close to zero. As the company gains assets, investment, traction, the price of those shares go up. But unlike in a public market where shares are repriced every day based on trading, shares in a private company are based on investor interest and also an external valuation when you start to issue stock options. Typically, what you'll see in a private company is that the share price of common stock will go up as the company gets bigger, but it will differ significantly from the stock price of preferred shares that are sold to investors. And very often, the price of preferred shares that are sold to investors have additional rights and protections associated with them and are actually priced significantly higher. This is a good thing for the company because it makes the common shares, or it allows the common shares to have a different price, which is often lower, which makes it easier to incentivize the employees you need to incentivize because you're guaranteeing them that spread so you can show them the upside. That actually relates to another question. Oh, before I move on, those prices converge as a company gets closer to an M&A or a public offering. And once a company goes public or when a company is acquired, generally all of the shareholders become common shareholders, and the preferred share price and the common share price converge completely. That butts up against another question we had. Typically, investors do not purchase common stock. And the reason that they don't do that is because having investors purchase common stock sets a share price of your common stock that matches the investor facing price, making it more difficult for you to incentivize people to actually work at the company using your equity. So typically what happens is that in the earliest stages, as Ryan mentioned, you will fundraise using what's called convertible instruments or convertible debt. Those are money now for equity later. And then as your company gets bigger, often at seed stage or Series A, you will start to see rounds that look like Series A or Series Seed. Anything with a series in front of it typically connotates that a new class of shares is being created for investors specifically. Those shares will get priced based on your pre-money valuation and the amount of money coming in, roughly with some other calculations for your outstanding convertible debt and things like that. Those shares will have investor-specific rights and protections that will allow them to be priced at a higher price than your common stock. Typically, those events and any big changes to your company also re-trigger the need for a new 409A. So you don't just get to keep your common stock artificially low. You do have to reprice it anytime a significant event happens, but that repricing is typically still significantly lower than the price per share of the preferred shares. Okay. We had a question about employee equity percentages at later rounds like Series A or even Series Seed. Typically, those percentages still stay for very, very key employees at low single-digit percentages. As the company gets bigger and bigger and bigger, then those will go down into fractions of percentages as you get going. But even at a Series A company, you're still typically hiring people that are going to be very key to the company. So single-digit percentages are not uncommon. Okay. A few questions around 83B filing deadlines and companies that don't get you the paperwork on time. From the IRS's standpoint and from a legal standpoint, you have 30 days after the grant date to get this done. The grant date is typically outlined and specified explicitly in the grant documents. If you don't get those grant documents, then you can be in kind of hazy territory. But if you're pretty sure that you got a stock grant or a stock grant was intended to be given to you at a specific date, you can always file an 83B kind of defensively, but also make sure that the company gets you the paperwork. If they can't get you the paperwork, that may be kind of a yellow flag. So yeah. The 30-day window from our perspective and the perspective of our partners is pretty cut and dry as well. So it can be difficult to loop back to this, and you typically need to engage counsel because it involves a lot of subtlety. So try to get that paperwork and try to get it filed on time. Okay.
Serve anything up or give you a break?
I think I can get through a few more of these. If you're also typing, that's great. What happens when you have non-US citizen co-founders? Are they named in the startup documentation upfront, or what other ways can it be done? It sounds like this might be verging on maybe an immigration and visa question, which we can't get into in detail. But yes, generally, even if you have non-US citizen co-founders, especially if they own a large chunk of the company, they will be on some Delaware paperwork that is quasi-public. They will be on your bank application and things like that, as what are called beneficial owners. If you are exploring immigration or navigating visa status, there are some other things to explore and different options in terms of ways you would structure ownership. We can't get in depth into that now, but we may be able to follow up with some additional resources after. Calvin asked if the platform has a dilution calculator. Kind of in a whole bunch of different areas. We help you understand the dilution when you are planning for a round. We help you understand the dilution when you are adding people to your cap table and things like that. but that dilution calculation is presented as you are going through different actions or kind of jobs to be done. And then we also have just the general round modeling and planning tools that will allow you to kind of explore at a high level. We had another question around somebody joining pre-revenue and pre-funding, and they aren't receiving any salary. Should they be considered part of the founding team? Again, that is up to the contribution that they're bringing to the table, and less necessarily about the type of compensation that they're getting. So, early on, typically you'll be granting common stock to anybody who's receiving an equity incentive. But in terms of how much you're actually giving them, base that on what they're bringing to the table. We had a question about board members and whether those seats only go to investors and whether or not non-investor board members get stock. So typically in the earliest days, the founders are the only board members of a company. And typically you'll see at Series A, or your first preferred round is most often when an investor will get a board seat. Any investors asking for board seats at earlier rounds, that's not normal. If they can be a huge value add, anything is worth considering. All startups are a little different, but it wouldn't be typical. And then you may also have essentially an outside advisor who is participating enough to warrant a board seat and kind of acts as a disintermediary between the people who are invested in the company and running the company day to day. Having kind of an outside industry expert can be helpful. Those people are often compensated with nominal salaries and may have kind of a small equity grant as well. They act as kind of like a super advisor. Yes, we will definitely be sharing the recording and the deck. You don't have to file an 83B if your common stock grant is fully vested, but be careful doing that because you may have to revest it in a variety of situations. I suspect that one might be visa related as well. Dennis is a Gust launch customer asking when we will hold office hours again. We hold office hours every 2 weeks. So if you are a Gust launch customer, basically what happens is if you have a question, you reach out to customer support. We share all the resources and tools that we have. Occasionally or often, because startups are hard and tricky, you'll have a question that would make somebody's fingers fall off if they were to type an answer. So we will invite you into our biweekly office hours. You get to share your question with other founders and we can go into a little bit more depth, more like this Q&A session. James is asking about determining a valuation cap on a saved or convertible note. And whether or not it's the same criteria as a normal valuation. Yes-ish. So you can use the same criteria to kind of justify a valuation cap, but really the most important way to look at the valuation cap and the way the investors are going to look at it is as a percentage ownership guarantee. Early stage investors need to own a specific percentage of your company for the economics to work for them. So they are using the valuation cap to try to guarantee that they own somewhere usually between 10 and 20% of the company directly prior to your preferred round. So while you can use some of the same underlying factors like team strength and traction to kind of figure out where you are, the best way to think about it is in terms of where you are in that 10 to 20% of ownership that they will likely get. So it is not in any way an actual valuation of your company, but it is a valuation that will have a percentage consequence in the future. And that is the way people are mostly thinking about it. Okay.
I'll let you read up and answer a real quick one because it's come up a couple times. It's coming up all the time is like, can you grant stock through your IRA or grant your stock to your IRA? I swear to God, there's a Peter Thiel article out there that is just messed with people's heads. So there are a lot of limitations around significant owners of companies. So if you're going to be the founding team member, a significant team member, like you're not going to be able to grant stock out of your IRA for the start of your running. The percentage is pretty low that you're not allowed to do that. Those examples are all coming from more of angel investor and early investors investing in startups and using tax preferential treatment for that. So whole other topic about angel investing and things like that. But as a founding team, if you're going to own more than 10% of the company, you're not going to use your IRA with that stuff.
Cool. Shalini, we do help overseas companies set up and operate via Delaware C Corps. I'm not sure if we have anybody from Australia, but we can definitely check. Natalie and Richard, I'll follow up offline on your safe question.
Oh, and a couple people asked this. If you're interested in Gust launch, you can book a one-on-one demo straight from our pricing page. We'll walk through who our solution is a good fit for, what your situation is. Everybody in the company has kind of the same level of expertise that Pete and I do. So check that out, and that'll see if it's a good fit.
Okay. There are a couple very specific questions that I don't think we can answer responsibly. So sorry if I skip those. We do have one on whether or not you can have a full-time co-founder CEO without salary but equity only. How does this typically work for pre-seed? So this is very high level. Do not take this as legal advice because you are in a gray area. Typically, startup founders operate in a gray area where they are not specifically designating themselves as contractors or W-2 employees. This allows them to effectively tiptoe around employment law and minimum wage requirements in the states where they're working. This can all work out just fine, and you can pay somebody in equity alone as long as they are willing, but you do have to keep in mind that you are taking on a risk. And that risk is that if the relationship sours for whatever reason, if this person was actually an employee during the time, which means they did not self-direct their hours, or they worked out of a company office with you, or your company provided them with equipment, any indicators that for all intents and purposes, they were actually and should have been an employee, then you can get into trouble because they can bring suit against you and things like that. So while it is not uncommon for startup founders to operate in that gray area, it is risky, and another good reason why you should go through the founder equity split tool and really have the conversations with your co-founders around expectations, because as things fall apart, those things can get messy because of the startup gray area stuff. And advisors and contractors are not full-time employees. And we actually have a great blog post on this that I will make a note to follow up in the show notes. But advisors are typically directing their own time. They are not working out of your office. They're in no way working 40 hours a week. They are not working on your equipment. They are self-directed and operating as independent contractors. Generally, the same is true for anybody who is validly operating as an independent contractor. And there are a couple of pillars of the test, but some of the biggest ones are self-direction of time and self-management of time, and whether or not they're working out of a company office and on company equipment. So as long as somebody is actually an independent contractor, then the minimum wage laws do not necessarily apply, but there may be employment laws that do apply to independent contractors. One other good thing to keep in mind when you think about these relationships is that having a contractor and advisor agreement for these types of relationships can be important, because while somebody who is acting as an employee, the work they do, all of that intellectual property belongs by default to the company. If they're acting in a contracting capacity, all of that intellectual property by default in the US belongs to them, and the company is granted a perpetual license. So part of a contractor or advisor agreement with a startup is typically the assignment of that intellectual property ownership. And that is a big deal because intangible assets are a huge reason why startups have value. And if an investor comes in and is looking at your company and your company doesn't own its intellectual property, that's going to be a big issue for that investment coming in. Okay, I think we got through most of them. And Ryan, you're muted.
Sorry, that was from my keyboard. I had a couple here that I wanted to get to. I've been chat answering a lot of the Q&A and the things in chat. This is kind of a fun one from Rashid. Is should I merge my friends and family with an angel investor network in my seed round, or should I leave them off the cap table to keep it clean? So this is something that comes up a lot. Often friends and family is recommended as in a place to get money. But there's a lot of stipulations around how you get that money and through what vehicle or instrument or agreement you get that. Often the friends and family of founders are not actually accredited investors. So investing in private companies, this is definitely for another talk about securities exemptions and filing securities and things like that. But the long and short of it is that they're not super high net worth individuals doing a lot of these investments. Chances are they don't stay on the cap table too long, and more often during cleanup, when you do go and raise a professional round, their money in will turn into kind of a loan or something that is less regulation expensive to handle and do paperwork around. So the idea of merging is like the money that goes into the company, the people who are on your cap table are it. You're not like merging them together. But if you did get friends and family around, money from accredited investors through actual fundraising instruments, and then later on you raise for angel investors, like everybody's going to be on the cap table in some form or another, whether it's holding a convertible note to future get on the cap table, or you do a preferred round and those existing people get whatever the redemption for their notes is.
Yeah, and this is a huge sticky ball of wax. There's not a great way to have unaccredited investors invest in your company and receive the same like locked in type of upside that accredited investors typically get through convertible notes or preferred stock sales. If you definitely want to do it and you definitely want to get those people on your cap table, regulation crowdfunding, or as WeFunder is now calling it, community rounds, is a good place to look because it'll take some of the compliance burden off. It does come at a cost as well because you do have to go through a provider. Otherwise, the majority of the other exemptions available are typically too expensive to justify the amount of money coming in, although there may be options in certain cases. If you leave those people off the cap table essentially and paper that money or think of that money as a loan, just remember that you are taking on the responsibility now personally to figure out what their upside in the company will be. If the company does really, really well, they no longer have any guarantees. It is currently difficult to make that guarantee for non-accredited investors. Cool.
All right, I think, did you get Natalie's question? No, that one's too specific. Sorry, Natalie, we can talk about that in office hours. I don't understand Miguel's question of, does that risk apply to advisors?
I answered it.
Thank you. And you talked about valuation caps and about market valuation and things like that. Thank you. Oh, I think we got it.
Cool. All right, so we will send a whole bunch of follow-up resources to this, including the video and the deck and some of the other stuff that we mentioned. If you are interested in learning more about any of this, certainly keep an eye out for future events and definitely come talk to us via chat on the site.
Awesome. Thank you very much for answering all the questions for you at the end, because I was almost losing my voice there. Thanks for a lot of people that stuck around past the clock. And this was fun. Have a great week, and we look forward to seeing you at more events like this.
Thanks all. Thanks, Ryan.